So what about the issues with the pension system in the US? The problems that they have been facing, all of these funds, in many cases will be harder to fix than some of those for Social Security. And the scale of the total potential shortfall is immense. Let's kind of get into this. There are basically two types of retirement funds in the US. One is a defined contribution plans such as the 401ks and the IRAs, which are tax advantage accounts owned and largely funded by employees themselves. Sometimes with additional contributions by employers, sometimes. The only real risk for these funds is that the investments in the account may perform poorly. Over the past 12 years, unfortunately, most stocks have gained little or have actually declined in value. As a result, many people approaching retirement today have far less money than they expected. Big problem. While such a shortfall is distressing, it doesn't compare with the dangers posed by the other type of plan, the so-called defined benefit plans, which promise to pay benefits to retirees based on the length of time they've worked and their former salaries. If these plans run short of money, they not only leave retirees unsure that their benefits are safe, but they also create a potential cost for whoever has to bail them out. Often, us, the taxpayers. Such plans can slide along for years, hiding their growing internal deficits with accounting tricks, but at some point the funding gap becomes too big to disguise, which is what is happening now. So how bad is the total problem? Let's add it all up. I start with the Social Security, which is paying out more than it takes in, not counting the trust fund, which will eventually be exhausted. That operating deficit will total more than $800 billion over the next 10 years, according to the actual government projections. The federal government employees, meanwhile, are covered by a more generous plan, which is called the Federal Employees Retirement System, FERS, FIRST, annuity, which tops up their Social Security. FIRST is also suffering from rising costs, which are now becoming burdensome. Indeed, the U.S. Postal Service has warned that it could default in not giving relief from its funding obligation. However, FIRST itself was reformed to control what we call the deficit being accrued by the old civil service retirement system. And although the government contributions have kept FIRST in balance for current employees, the unfunded liability for employees is still covered by the old system, totals more than $630 billion. While there's no more real risk with the federal government, this will be unable to pay promised benefits. The cost has led to calls for restructuring the system more aggressively and requiring employees to contribute substantially a lot more money. Since the recession, most states have been trimming pension costs for public sector employees. A good example of this would be the journal reports that 31 states have reduced benefits for new hires, 26 have required higher contributions from workers, and 9 have reduced costs of living adjustments for retirees. Nonetheless, a huge unfunded liability remains. Boston College calculates that such cuts have reduced about $900 billion shortfall, only $100 billion less. Unlike federal pension funds, which covers a broad cross-section of employees, state and local plans may vary enormously from one place to another, so that the worst are much worse than the average. The portion of these obligations that are funded varies from more than 80% to less than 40%. So finally, and to concrete this, corporate pension plans are in the red. More than 2/3 of the companies that make up the S&P 500 have defined benefit plans, and as of last quarter, only 18 of them were fully funded. 7 had shortfalls of more than $10 billion apiece. According to the New York Times, all told, the unfunded liabilities add up to around $355 billion, or about 22% of the promised funds benefits. Moreover, recent legislation has allowed these companies to to be more optimistic returns assumptions. In the very short run, such changes take financial pressure off the troubled companies, and it also boosts corporate income tax revenue for the government by reducing, say, deductions. But in the long run, the deficit is increased and eventually has to be paid. That's the problem.